short put butterfly spread, another strategy that will allow us to make money both ways in the stock market. Now remember, before you ever enter this options trade or any other options trade, please make sure you know how to close it. I'll pin a video in the comments section below where I show you guys how to close out of any options trade. Now let's first start by talking about what our goal here today is with this particular strategy. So when it comes to the short put butterfly, our goal is going to be to profit from stock price movement up or down with limited risk. So again, our max loss is defined. We know what the most we could potentially lose is before we actually enter the trade. And so the ideal situation for this strategy then is you believe a stock is going to make a move, but you're not quite sure whether it's going to move up or it's going to move down. So for example, could potentially be earnings coming up for the stock, or potentially some sort of new product launch or FDA approval that's pending. Any type of event that could potentially cause a stock to move in price, but it could potentially go either way, right? It could go up or it could go down. So for today's video, I'm going to be using ticker symbol CVX. This is Chevron. Keep in mind that what I'm going to show you here is just an example, so don't copy this exact same trade. So before we actually go into the options and talk about the short put butterfly, remember, there's always two important things you need to check. First one is commission fees. We are going to be opening multiple contracts here and then closing them. If you're on a broker with high commission fees, that might eat away at a lot of your profit. Now, Robinhood doesn't have any commission fees, so we don't have to worry about it on here. Number two, we are going to be selling options. Anytime you sell an option, there is risk of assignment. We want to avoid being early assigned due to the ex-dividend of a stock. So you should always check, does the stock have a dividend? If it does, when is the ex-dividend date? You want to avoid selling options on the week of the ex-dividend. If you do sell options that week, you want to close out 2 days before. So remember, we can always go to NASDAQ.com and search for whatever stock we want to use. So here again, we are using CVX. And so here is Chevron, so I'll click on it. Then on the left here, there is a dividend history link. So we're going to go ahead and click on that. And then on here, it will show us if the stock has a dividend and if it does, when the ex-dividend date is. So taking a look here, looks like the last ex-dividend date was February 15th. And if we take a look at their history, it looks like the next ex-dividend will probably be around May 18th or so. So we don't have to worry about it for, the next week or the next 2 weeks here. So once we've checked those couple of things out, we can go back here and go into the options for this stock. So let's take a look here. So here we are now in the options for CVX. And so let's get into how we would set up the short put butterfly. Now, firstly, I want to mention this here. You do not need 100 shares of the stock to use this strategy, okay? Now, again, we're focusing on the short put butterfly here today. So short because we're going to be entering for a credit. Put because we're only going to be using puts here, and of course this is going to be a butterfly spread. So first I'm going to go ahead and filter to puts here. We're only going to be using puts for this strategy. So now we can actually start setting up this strategy. So the very first thing you want to do is you want to try and determine if the stock price ends up going up. Above what price do you believe it's going to go above? So let's say that if CVX does end up going up, let's say I think it's going to go above, let's say, just say 185. Okay. So what we do is we'd start by selling a put at that strike. So I'm going to go to 185, which is right here. And I'm going to start by selling a put right here. Now we want to do the opposite. If instead the stock price ends up going down, we want to try and determine what price will it go below. And then we want to sell another put there. So let's say that if it goes down, I think it's going to go below 160. So I'm going to go over to the 160 strike, and I want to sell a put at that strike. So far we're selling a put at 185 because we believe if CVX goes up in price, it's going to go above 185. And then we're selling a put at 160 because we believe if it's going to go under, or if it's going to go down, the price is going to go down, it's going to go under 160. Now what we want to do here is we want to go exactly in between both strikes and buy 2 puts at that particular strike. And so to do that, you would basically add these two strikes and divide by 2. Here, that would give us 172.50. So that's going to be the strike that's exactly in between both of the strikes here, both of the strikes of the puts that we're selling. So this is the one that's right in between those two. So I'm going to buy 2 puts now at that strike. So I'm going to switch to buy, and I'm going to buy 2 of these puts. So let's click on here. So far, we're only buying 1 put. If we want to buy more than 1 option or sell more than 1 option here, what we want to do is we want to click on this drop down on the top right, click on custom, and then go to the buy put here and go and do 2 here, okay? And so this is what this one is going to look like here. So like I mentioned earlier, this is the short put butterfly because we should be entering for a credit. And as you can see for this particular example, about $736. So you're gonna get paid $736. And of course, you're gonna have to end up putting up collateral. But as you can see down here, you can already see that we're gonna be able to make money both ways here with this strategy. Now, again, this really doesn't tell you the whole picture here. So I like to go over to option strat to visually take a look at what your profit and loss will be depending on the date, depending on the share price, depending on implied volatility. So we're gonna go over to option strat and visually take a look at what this trade looks like. Let's go to build. And they actually have under directional here a short put butterfly link already. So we'll click on that here and let's take a look at this one. So firstly, we are using ticker symbol CVX. So let's choose our stock. And then we chose the expiration of April 22nd. We just left it there for this example. And so remember, we started by determining if the price of the stock goes up, what price do we think it's going to go above? So we said 185. So we sold a put at 185. Then we said, okay, if the price actually ends up going down, what price will it go below? We said 160. So we sold another put at 160. And then we said, okay, now we need to find the strike that's exactly in between both of these strikes. And so we added these 2 strikes, we divided by 2, we get 172.50. So that's the strike that's exactly in between these 2. And we said, now we need to buy 2 puts at that strike. So this actually already has all the exact strikes that we chose for our example. But as you can see, right, we're selling a put at 160, selling a put at 185, and then buying 2 puts at 172.50. And so this is the exact same trade we just saw on Robinhood. So we're entering this for a credit, $736. Max loss is $514. Max profit is going to be the credit or the premium that you received when entering this trade, which is over here again, $736. And then we have our break evens. So basically, if on the expiration we're at 167.36, we'll break even. Below that, we'll make money. Or if we're at 177.64 on expiration, we'll break even. If we're above that, we'll make money. So let's take a look at what this looks like now. So here is what it's going to look like. Okay, so again, this is going to be a strategy where you're going to want the stock to move either up or down. You do not want it to trade sideways because that's where you're going to lose money. You want it to either rise a bit or drop a bit. So as you can see, our max profit here is going to happen if the price of the stock gets to either of these strikes of the puts that we're selling. So on the upside, if it gets to 185 or higher, that's where you're going to make your max profit on the expiration date, as you can see here. On the downside, if it gets to the strike of the put we're selling, 160 or under, that's where we're also going to make our max profit of $736. So that's the ideal situation, is for on the expiration, the stock gets to either of these 2 strikes. If it's the higher strike, it can also go above. You'll make your max profit. If it's the lower strike, it can also go below and you'll make your max profit, as you can see here. Now, of course, you can also make money even if it's not, if it doesn't go this high or this low. And again, we can see the break evens here. So as long as you're under 167.36, you'll make money, or as long as you're above 177.64, you will make money here. And again, this allows you to see approximately how much your profit would be. Now, another thing here, right? Our max loss, 514, that sounds pretty scary, but keep in mind that your max loss here is only realized at one price. That price is going to be the strike of the puts that you bought. So if on the expiration, this stock is at 172.50, that's where you're going to lose your max loss. That's the only price and the only time you're going to lose the most you can lose here is if this expires and the price of the stock is exactly at 172.50. Now that's very unlikely to happen. And as you can see, if it starts to go up, you start to lose less and less. If it starts to go down below the strike here of the put you bought, you start to lose less and less as well. Okay, so keep in mind your max loss is only realized at exactly one price, 172.50 for this one on the expiration here. Now, the other thing, of course, is you can close out any time before the expiration. You don't actually have to wait until the expiration. So let's say, it's April 20th and this is down to, 166 or 165 and you're up, 130, 200 bucks. You can close out at that time. You do not have to wait until the expiration date to close out of this strategy. Close out any time before. And of course, the other thing we always have to check here is changes in implied volatility. So if IV drops, if IV completely drops here, look what happens. As you can see, there's not really a big change here, right? There's not really going to be a big change with IV, which makes sense because we're selling the same amount of options as we're buying. And so this is why this is not a horrible strategy to use for earnings because there's not really going to be an insane amount of IV crush here. Now, if IV starts to go up, you do start to see more green. As you can see, there's a lot more green, there's a lot less red. There's not a dramatic change here, right? As we've seen with some other strategies, but it's always nice to see what is going to happen if IV drops or if IV goes up. And so again, this option strat website allows you to do that. So anyways, this is the short put butterfly. Again, the strategy allows you to make money both ways, up or down. However, you do not want the stock to trade sideways because that's where you're going to lose money. You want it to go up or down here. So anyways, if you have any questions about anything I just talked about, feel free to leave them in the comments section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.